This will blindside everyone. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, this unexpected shift is about to change everything. And I want you to see why nobody can see it coming. They've already got their minds made up on what the outcome is, and yet they can't see how this is about to have a detrimental effect on the economy. Now, if you're wondering what we're doing back in the good old US of A, well, we had to get out of China and quick because, as you know, they don't like it when people talk about deflation. And that's been our focus, is where the global economy is headed, started with them. And what does that have to do with, of course, the residential U.S. housing market? Well, I'll show you in a bit. I appreciate all the kind comments and concerns. I want you all to know that I am just fine. I'm going to put a pinned comment in today's show so you can hear what's going on, but I wanted you to know that I love and appreciate all of you. Let's over to Bloomberg, where we picked today's story up with a headline: U.S. shelter inflation may go negative next year, according to a Fed study. Now, that means shelter inflation, according to the Fed, again, this is a research report, says it could go negative, and that means deflation in the housing sector. Now, that doesn't make a lot of sense, because what we're hearing from all of the experts is that inflation is going to rear its ugly head, and if the Fed doesn't keep an aggressive press on higher interest rates, that all it's going to do is pop back out of that bottle, and then we're going to have to fight it a whole second time. So that's the broad narrative. But yet here we see this report coming out that says, well, maybe that's not what's going to happen. Our baseline forecast suggests year-over-year shelter inflation will continue to slow through late 2024 and may even turn negative, that'd be deflation, by mid-2024. This according to the San Francisco Fed economist, who wrote in a note published on Monday. This would represent a sharp turnaround in shelter inflation, with important implications for the behavior of overall inflation. And the question is, why is that? Well, because shelter inflation is a huge component of the consumer price index, which I'll show you in a bit. But I want you to see how its lagging effects could really put some major downward pressure on the index at a time, again, when everyone's calling for inflation just to come roaring back, and the Fed's even worried about it too. And here you can see in this chart, we've got three lines. We've got the consumer price index, that's the headline one in blue. Then we have the core CPI, which strips out food and energy. And then the third one in green is shelter inflation. And what I want you to see is usually the core CPI heads lower because, as we know, its main components are due to energy. And then the core CPI lags to the downside. But what you can see is housing, that shelter inflation, it lags all of them. And it generally does. Now, there's some times where you see oil take off, as we did during the global financial crisis, that the headline CPI shot up and then came crashing down. But notably, what you can see today is this shelter component is just starting to roll over as the headline is crashing down and the core is coming down. And this is expected to take a while, because you can see just how big that move up was. Well, it's going to be a while, as the Fed says, perhaps into 2024 before it gets even down to normal. And the so-called core measures, which strip out volatile food and energy prices, have been slower to recede, which is exactly normal. We should expect that. The core CPI never leads the headline CPI, and if it does, it's very rare and very unexpected because of something called energy. So it's almost a surprise, you see, to the author of this article to say, wait a minute, this isn't right, but yeah, it is. Leading to worries that it could take more tightening to bring inflation down to the Fed's 2% goal. Well, that's not it either. It's a lagging indicator. It just takes longer because, of course, the shelter component, which is a big factor, it comprises more than 40% of the core CPI and is an important part of that battle. So here we hear from the Fed that says, wait a minute, it may be till, say, late 20 or mid 2024, maybe even early 2024 before we see things really moderate this space, and yet that's going to put pressure on the Fed. And we know they're talking about how they've moved that goalpost from the headline CPI to the core, because what do we know that Jay Powell wants to do is he wants to keep rates up. He actually wants to further hike them, and he wants to keep them at this level for an extended period of time. Well, if that's your objective and you're the Fed chief, well, what benchmark would you want to use? Well, you want to use the core CPI because of this big overweight to the housing market, which you already know from your own Fed research reports could take a year to get back down to a 0% inflation rate and maybe even go negative. Well, if that's your goal, then you know you can keep that funds rate up. And that's why we're seeing the Fed do the decisions it is, because it wants to keep rates higher, but they're not. Because markets are going to be blindsided by inflation's comeback. Well, that again is the threat here. And Jay Powell is seeing the same thing. He thinks this is the 1970s again, and inflation is going to come roaring back. And that's why he moved the goalpost, because he has to keep Fed funds rate up under the belief that the funds rate controls inflation. Of course, we know that has nothing to do with it. But when you're the Fed chief and you have two policy tools, the funds rate and the balance sheet, that's all you can do is push rates higher and use that as your excuse until inflation gets down to the level you want and stays there. But many still think inflation is going a whole lot higher. After a year of falling, commodities have started to climb, especially oil. And not that much, though. It's benefiting from a number of tailwinds, foremost among them buoyant liquidity conditions. And keep in mind, when you can't explain why something in the market goes up, just throw the word liquidity out. Everyone seems to believe it, even though it doesn't really have anything to do with anything. Global real M1, this is money growth, is one of the simplest measures of liquidity, and it continues to rise. Oil and commodities should follow. Here's a chart from Bloomberg, and here you can see global real money, a strong tailwind for commodities. That would be the black line, and that would be the commodity index. The global M1 is down here, and they're saying this move higher in the M1 because it's down has to go way up because, well, it's always gone up, and if it does, that means commodity prices go up and inflation goes higher too. But does it? Well, not so much, because what we understand is when you look at the consumer price index in blue against West Texas intermediate crude oil prices, this little hook higher isn't that big of a deal. In fact, we've seen little hooks higher on the way down. We've seen other hooks higher at other times. It doesn't necessarily mean that because the M1 is headed up, that oil prices are headed up, because what do we know about energy prices? It's about demand. And so if the global economy is expanding, the need for energy and demand for energy goes higher. So if global demand is slowing and expected to slow, well, energy prices aren't likely to go a lot higher. They might move over a couple months, ebb and flow, but does that mean inflation is going to shoot higher? Not at all. But then they say, wait a minute, what about rising global food prices? See, those hooked higher too. And of course, if that's going to happen, well, the CPI is going to do an about face and go straight back up, because look at this chart. Here you can see food prices tend to lead the CPI, even though they don't necessarily always lead it. Well, let's take a look at our chart where we have global food prices now in red. And what we can see is this minor hook is no different than the minor hook, well, a few months ago, or the one before that, or any of the other ones that have happened along the way. And it doesn't mean that consumer prices are going to again do an about face. What it suggests is that perhaps there's just something in the data that causes food prices to go up over a couple months instead of down, because data doesn't move in a straight line. What you're seeing so far is what all of this suggests is a consumer price index is more likely to come down. But of course, many people can't see the shift that is eventually coming. We're going to get to that in a bit. But I want to further set the stage that all of this nonsense that the inflation is just going to magically turn up isn't in the data. Here we see China Producer Price Index, something we talk on a regular basis. Look, it hooked higher. Well, guess what? It hooked higher a couple of months ago too, and even a few months before that it moved up, and that didn't change the broad direction of the Consumer Price Index. But we do know, of course, where China producer prices go. That means, of course, U.S. consumer prices follow, because so many things that end up on our shelves here, well, they're made in China. And so where Chinese prices go, you see here, this little hook is getting people excited that perhaps this is the beginning of a whole new move higher. But you can see on the last move lower, there were hooks, plenty of them. And guess what? The trend was still lower, because what did we just talk about with China in the show yesterday? It's all about supply and demand. It's not just internal supply at China or internal demand. It's external demand from countries like the U.S. and other parts of Asia and South America and Europe. And what do they say in all the reports? Demand is down. And so what could we likely expect from today's CPI report? Was it would head lower? Well, that's not exactly what happened, but maybe this is just a little hook in the continuation of a lower trend. As U.S. core CPI posts the smallest back-to-back increases in 2 years. And something that shouldn't be posting the smallest back-to-back increase is your trading account, because if you had CTA-Timer Pro, our machine modeling program with a historical overlay, well, you would have nabbed this tech stock rally where we first said to buy back in down here. And then we said, hey, if you missed that one, buy in here. And now up here it's saying, you know what? You need to start locking in some of those gains or closing out your positions, which many people said, there's no way to your historical modeling that this thing will catch the top. And there it did. You can see it. You can check the reports because I've got copies of them for you right here. Here you can see on January 9th, the machine started to short cover. That was your first indication to take a position, throw a stop loss on, and buy into the rally. Here's your second one. If you missed the first one, this pullback, the machines were buying out of it. There was your second one on March 15th. And here you have it. On July 27th, the machine started backing off their long positions, and we told you that's the first sign to either raise your stop loss levels or start to close out and capture some of your gains. With what we've seen since then, you can see the report is absolutely amazing and can be yours for $30 a month, and comes with a 30-day in writing money back guarantee. Check it out. You'll be amazed at what a difference it'll make in your trading. The core consumer price index, which excludes often volatile food and energy costs, rose a mere 0.2% for the second month, according to the Bureau of Labor Statistics. That marked the smallest back-to-back gains in more than 2 years, suggesting that inflation is indeed slowing down. So perhaps what we're seeing in these year-over-year comps is just something from a year ago that's causing a little hook up in the data, which isn't really a big deal. It can be just a statistical anomaly as part of a longer trend, because we know data does not move in a straight line at any point. And if it is, it's usually because something bad's happening. And here you can see the CPI on a year-over-year rate of change actually rose 3.2% from last month. The core slowed slightly to 4.7%. Again, just part of the trend lower here, but that's not really what the shocking issue that's coming, because most people can't actually see it, even though I'm going to show you in the data today what's coming, and that means CPI is headed lower. As the progress on inflation combined with solid economic growth and a healthy but gradually cooling labor market. Wait a minute, cooling labor market? We've been hearing how the labor market is strong and robust, but that's a little bit of a tell of what's about to come. Represent another step in the right direction for the central bank. The highest interest rates in 22 years have played a role in calming price pressures, which is ridiculous because they haven't, according to the Fed. But yet to tip the nation into recession, many economists once thought was inevitable, because they've all changed their minds since the stock market has turned around and gone up. But of course we know that the stock market does not necessarily mean where inflation and the economy is going. We know the recession probabilities are much higher than everyone expects. We know the labor market is cooling despite what the Fed and other policymakers say, and is going to have major problems, as you'll see here in a little bit. Because let's carry on this inflation story, because again, the bottom line is everybody thinks inflation is going higher. I know I'm one of very few people that think it's going lower, and that's okay that we don't agree. Let's continue to dig. Here you can see the net percentage of domestic banks tightening lending standards for commercial industrial loans for firms of all sizes. The issue isn't that the Fed raised rates to the highest level in 22 years. The issue is that banks are tightening lending standards, and you can see that happen every time the blue line crosses that horizontal black line to the upside. And whether it's any point it's above it, it means on net banks are tightening standards. Now, what's important to understand, in a debt-based economy, when banks tighten lending standards, do you remember what that means? That means they originate fewer loans. And that means less new money is being created. And if there's less new money being created, well, that means there's less money for economic growth and to service all the debt. And so if there's less money, there becomes less demand. And when there's less demand, what happens to CPI? it goes down. And here you can see the red line, that's the consumer price index, the headline, not the core. You see as banks tightened lending standards, eventually it slowed and came down during the dot-com bubble, happened again during the global financial crisis, and without a shock. You can look at the timing of this, and you can see at the same point the banks on net started tightening lending standards. What happened? The consumer price index came down. Because what do Americans, how do they spend their money? Well, they actually spend money they don't have frequently by borrowing on credit cards and other loans. So if they can't access credit, they can't buy stuff they can't afford, can't buy stuff you can't afford, prices come down. It starts to make perfect sense, especially when you add on to the fact that wages have been falling behind prices. And that's an issue because if prices are rising faster than wages, it means you can't afford as much, and that's validated here. Let's take a look at total compensation, which is average weekly hours multiplied by the average hourly earnings of production and not in supervisory employees. This is a rank and file of the American worker. We're going to put that up against the consumer price index, that in red, and we've got them on the same side. So you can see these are equivalent. I didn't adjust one to the right so you could see it. They've got them both on the left side here because I wanted you to see that total compensation in blue for quite some time has lagged behind the consumer price index at a point where interest rates were higher, service costs on debts were higher, and that meant, of course, inventories were up as we talked about yesterday, and that means consumers could not spend what they wanted to, and when they can't do that, it means inflation comes down, and that's the fact that everyone can't really see here, is this is happening because there just isn't the demand for goods and services because people can't afford it. But that's not the overall issue here. See, what's coming is far worse. The policymakers say, look, inflation is coming back. The labor market is strong. The economy is going to boom. But that's not what the data said today. Let's go a little further. The details showed more than 90% of the increase. So get this, 90% of the increase in the overall CPI was due to housing costs that would have otherwise moderated since the start of the year. And that's why I wanted to show you in the beginning of the show that the Fed said, look, this housing cost thing, it's going to smooth off and go away. You know, by the early 2024, it's going to be a whole lot lower. And by perhaps mid 2024, it could be deflating. It could be negative. And yet everyone's saying, look, the consumer price index hooked higher. The data says it's because of one component in it. It affected the whole index. Used car prices, meanwhile, fell for a second month, while airfares posted the biggest back-to-back declines since the start of the pandemic. And why did they do it? Because demand for travel is going down. I happen to know that because I live in the travel destination of the world. And guess what? Things here aren't that busy because people can't afford it. And now we look to this, the U.S. jobless claims. Actually, this was wrong. That shouldn't have been on the show. A separate report Thursday showed applications for unemployment benefits rose by the most in 2 months. Continuing claims of proxy for the number of Americans receiving benefits remain relatively subdued. So what have we been hearing? That these initial claims, well, they should have settled down. They started getting back down. And now I want you to see they're headed back up. And look at this, initial claims for the week of August 5th, up 21,000 to 248, getting back to that mythical 250,000. That line in the sand, I said, once it breaks, we're in trouble, and it got there, and it reversed. The 4-week moving average is sitting at 231,000, so it pulled back a little bit. But look at this, continuing claims dropped a little bit, but still are holding around 1.68 million. Total claims, you include everything on an unadjusted basis, sitting at 1.85 million. Only down a little bit. And here is the issue, because when consumer price comes down, when you see the inflation slow, what does that mean? Does it mean just prices come down? It does mean price growth slows. But why is price growth slowing? Because demand is coming down. So if you have a store or a warehouse or a manufacturing company or something, and demand goes down, what do? Well, you start to trim back. You start to make adjustments. And if demand still doesn't return and you've got your place cleaned up because you got workers doing things, well, I've been putting that off for years, I'll get them to work now, and you run out of things for them to do because you don't have enough new business, what happens next? Well, they hit the unemployment line. And that's why you see here, as consumer price index goes down, which the Fed thinks is just about prices, but it's really about demand. When demand goes down, well, the 4-week moving average initial claims goes up. We see that happen back here in the early 90s. You see it in the early 2000s. You can see it again during the global financial crisis, and you're seeing it now. And even though it kind of rolled over and dipped back down, what I want to suggest is that was just a short-term effect, that if demand didn't return, what we would see is more people start to get laid off, and we're starting to potentially see that again. And that's bad news, because you think about where the economy is headed, and that a lot of employers have been hanging on to employees hoping demand comes back. Only leaves the question is, how many are they going to lay off? And the more they lay off, well, the more demand is going to drop, because what they get on unemployment is far less than their current wage. But yet one shipping CEO sees green shoots, says container rates must rise. Well, of course they must rise, because costs have gone up, and well, that means rates need to go up, means demand needs to go up. And he says the market is definitely still not as strong, but I think we see some signs of stabilization. We've just seen a bit of an uptick as we anticipated, but now we need to see how long that holds. And why would we see an uptick? Well, the holiday season's eventually getting here, and that means new stuff needs to get on the shelves. The transport and logistics market remains depressed, and a sluggish economic growth and persistent inflation were expected to weigh on consumer spending for the rest of the year. But Jansen said somewhat of recovery in demand as the industry moves closer to peak season, which typically runs from August to October, as retailers and other importers order more goods for back to school and year-end holiday shopping. So we'll be watching this from August to October to see if there is much of a pickup. But if there isn't and it turns down, it tells you the probabilities of recession by the end of the year and a massive unemployment are very high. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.